Tom Lee said on Friday, you should buy the dip in stocks heading into this week's jobs report. And judging off of that crazy end of the day rally we seen in the NASDAQ, S&P, and small caps, it would lead me to believe this upcoming week's gonna be pretty strong. But here in this video, we will take a look at what Tom Lee just said about the month of June, just to remind everyone, and all of your major data points coming out this week and my expectations. Also, what I'm potentially looking at trading for this upcoming week with small caps. First up, Tom Lee on Friday said you should buy the dip in stocks before next week's jobs report. And that was because inflation, your PCE, the Fed's preferred measure of inflation, came in better than expected on Friday. And that alone can be a big tailwind for stocks for a couple of weeks. Tom Lee looked at the data, and ever since 2023, anytime you have gotten a PCE report that has come in better than expected, and you sold off 1% before that PCE report, you actually tend to be up almost 3% the week afterwards. And ever since 2023, that has had a 100% accuracy rating. So in simpler terms, that means this upcoming week could be a big up week for especially your small caps and interest rate sensitive stocks. Just to remind you of what Tom Lee said this is the best core PCE month over month for all of 2024 and supportive of the notion that inflation pressures are abating. Tom Lee thinks future PCE reports will continue to show disinflation, which should boost the chances of Fed interest rate cuts later this year and support higher stock prices. Tom Lee basically goes on to say that if you exclude housing, and really the way the government calculates housing inflation is ridiculous anyways, but if you exclude that, the Fed's already at their 2% inflation target. Thus, Tom Lee believes there's a high probability that stocks perform well into next week's May jobs report. Now, when Tom Lee actually said that, and when that article was written, it was actually after your Chicago PMIs came out and caused stocks to sell off. Now, a lot of people said it was the Chicago PMIs that caused stocks to sell off. I think it was Dell earnings, in which Dell earnings came in at consensus for the most part. It wasn't spectacular, and it definitely didn't justify the AI run-up that Dell stock has seen recently. But that really hurt all of your AI stocks, and it really threw AI into question, and I think that's what sold off the markets for the most part. As I say all the time here on this channel, the markets can handle bad news. They cannot handle uncertainty. Dell earnings were bad news, according to the AI trade, and well, the markets got over it towards the end of the day. And even in after hours on Friday, the Russell was up 0.33%. We're probably going to start off this week on a high note. But whether or not we continue to be on a high note throughout this upcoming week, that's going to come down to the data. And it's not just the jobs report. There's a ton of data this week. So keep in mind right now, the markets have this perception that when the economy weakens or data reports show weakening in the economy, that's good news for stocks. It's important to remember that a little weakening is good. A lot of weakening, that is bad. And if you are in the camp of the Chicago PMIs on Friday were the reason why stocks sold off, that fits that narrative perfectly. PMIs, Chicago PMIs came in really bad, stocks sold off. Now, again, I don't think that's what happened on Friday, but if the data comes in too bad, raising recession fears or odds, stocks will sell off. Keep that in mind. So coming on Monday, you have ISM manufacturing PMIs, expecting those to rebound a little bit to 50 last month at 49.2. I don't think this one, means too much, but this one specific data point within manufacturing does. ISM manufacturing prices. Okay, this is the specific component of manufacturing that calculates your inflationary pressures. Last month you came in at 60.9. That was a very inflationary reading. You're expecting 61.3, so I think expectations are high, and there's a good chance that this comes in lower than expected and could lead to a really good continuation for markets on Monday, as long as those prices paid numbers do not come in higher than expected. Now, on Tuesday, you're going to get JOLTS job openings, expecting these to be really unchanged from last month. Last month, you came in at 8.488 million. You're expecting about 8.4 million. So you're not expecting much of a change there. Again, The best way to look at JOLTS job openings is if your local restaurant is looking to hire 10 employees, then they're probably doing just fine. If they're looking to hire more employees, the business must be doing well. If they cut that back, let's say to 5 employees, well, maybe the business is not doing as strong as it was before when they were looking to hire 10 employees. That's kind of the way to look at it. So a big drop in JOLTS job openings may actually be seen as a bad thing for the markets, a bad thing for the economy, and a bad thing for a recession. But a slight drop, maybe 100, 200, 300,000 jobs, that could actually be seen as good news, maybe slowing down the economy enough to get the Fed to start cutting rates. Now, on Wednesday, you will get the Bank of Canada interest rate decision. You are actually expecting the Bank of Canada will cut rates coming this Wednesday, and that could be a positive for our markets, something to be watching for. At the same time, at 10 o'clock in the morning on Wednesday, you will get ISM Services PMI. This will be a big catalyst for this week. Last month, you came in at 49.4. You're expecting 51. So you are expecting services, activities going to go up a little bit. That's not a huge deal. You're basically at neutral right now. Any number above 50 is positive. Any number below 50 is contractionary, okay? So that's not what I think will give the markets the big move on Wednesday. It's again the ISM services prices. Last month you came in at 59.2. Estimate is you'll come in around 60. So if that number comes in higher than 60, that's what will dictate whether or not Tuesday is a good or bad day. And also the Bank of Canada, if they do, end up cutting rates, that could have a positive tailwind effect to our markets as well. And you do have some bond auctions spread throughout here. Couple other smaller events as well. I'm just going over the big stuff. If you guys want to pull this up on your desktop, your phone, or your tablet, whatever you use to, get your news when you trade or invest on any given day, just type in tradingeconomics.com/calendar. It's a free tool and it shows you literally everything. The things that are highlighted in black, just by the way, are, medium volatility catalyst. Anything highlighted in red is expected to be a big volatility catalyst, okay? And some of them are not, like this over here in Europe. Thursday, you do get the ECB interest rate decision. You are expecting the ECB will cut rates as well. So Canada and the ECB are expected to cut rates. Could be great for our markets. It might actually start raising the odds of, the Fed cutting rates. I believe the Fed will cut rates July 31st. That's my opinion. I think we need to get inflation readings that continue to show disinflation. We have 2 more inflation readings before July 31st, that Fed meeting in July. 2 more economic reports, 2 more of basically everything besides GDP. I think the Fed's going to have enough confidence to cut rates by July 31st. And if that's the case, considering today's June 2nd, yeah, we could be looking at a very strong June, if not a very strong July, as the markets start to price in that first cut. But again, it depends why the Fed is cutting rates. Normally, markets, or S&P, I should say, sells off about 23% following the first Fed rate cut. That's usually because the Fed is cutting because a recession is here or on the near-term horizon. As long as there's no recession in sight and the Fed's cutting rates, that's bullish for small caps, bullish for interest rate sensitive stocks. Now, continuing on Thursday, you are going to have exports and imports. Usually not a big deal, but this could be a little bit bigger of a deal because it does affect your GDP estimates. GDP estimates have been falling recently. The Atlanta Fed GDP Now tracker is estimating about 2.8% GDP for Q2. That is down from over 4.1% you had just back here in May. That could be a little bit important. You also have initial jobless claims coming out, expecting a actual down move from about 219,000 last week to 215,000 for this week. Now, on Friday's going to be your biggest data of this week, arguably. I think the ISM services number, the prices paid component, and ISM manufacturing prices paid components are going to be very important as well. But non-farm payrolls, you're expecting around 180,000 job ads. Last month we came in at 175. So you're actually expecting the non-farms number is going to come in a little bit better, a little bit more positive than what you had last month. Although Trading Economics forecast is around 151,000 job ads, I think that's probably around the range we're going to come in as. Maybe 145 to 165. I do think it's going to come in slightly below Wall Street's consensus view right now. Not enough to cause recession fears. We're still adding let's say a theoretical 150,000 jobs a month, but maybe not as strong as Wall Street is expecting. And I think that will be a big positive for stocks coming on Friday. You will also get the unemployment rate, expected to be 3.9%. Again, same is true there. If the unemployment rate jumps to 4.2%, whoa, might be some bad news. If the unemployment rate ticks up to 4%, might be just enough weakening to, get the markets to move higher and people to get excited over that. Your biggest economic data coming out. Let me know what you think about that down below in the comment section. But we do have some earnings as well that may or may not be important. You do have GitLab Monday and after hours, CrowdStrike, Hewlett Packard Tuesday and after hours, Wednesday pre-market, Dollar Tree, Ollie's, Campbell's, and a couple others. Wednesday after hours, Lululemon, ChargePoint, Victoria's Secret, Five Below. Thursday at pre-market, Neo, Cena, Big Lots, Toro, the JM Smucker Company, and that's pretty much it. Thursday and after hours, you have DocuSign, Samsara, Rent the Runway, and Braze, as well as Vail Resorts. Now, I really do think an attractive trading potential opportunity is in the small caps for this week. I do think the start of the week could be pretty good. I think the prices paid numbers are going to be interesting. They're pretty volatile. They could come in higher or lower. I think that's maybe a little bit more of a wild card, but towards the end of this upcoming week could be very strong as well. I'm potentially looking at a breakout of the Russell, maybe even to a new high of 2024 this week. As long as the data does not come in, bad for whatever reason, you could see the Russell, have a 5% week this week, maybe even, around there, maybe a little bit more if things are good. 5% from here would put IWM at about 216. And I think that is, as Tom Lee has said before, the sleeper trade of 2024. Let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.